Hello and welcome to the Valuation Methodology course. We are here to lay the foundation of commercial real estate valuation so that as we dig into the details in the subsequent videos, all of that information will fall nicely into place with our broad understanding. So the first thing that we have to do is we have to think of every property as its own standalone business. Businesses have income and they have expenses. And when you net those two together, you get your profit. Well, properties operate in the exact same way. They are in the business of leasing out the space within their building. And now each asset class is going to operate slightly differently. For example, hotels, they rent out their rooms for single nights, but an industrial warehouse will rent out that space for years. So each asset class will operate slightly differently, but step one for all asset classes is you have to determine what is the gross potential rent that I could possibly earn in this property in 1 year. And now that means I'm 100% occupied 100% of the time, and I haven't lost any of that revenue. But the truth is, you're not going to earn that much money. You are going to earn less than that because there will be vacancies. There will be bad debt where people just don't pay, and you may have to offer concessions for people to rent your space because there's a lot of competition out there in commercial real estate. And once you net all of those things out, that's going to get you to your effective gross income. Now, that should be cash, total cash in your pocket at the end of the year, before any expenses. So that is the total revenue coming in on your property at the end of 1 year. So what do we have to do next? We have to calculate the operating expenses. How much does it cost for us to earn that much revenue? Now, there's a lot of costs associated with owning a property. You have to have insurance. You have to pay your property taxes. You have to upkeep the property. You have to shovel when it snows. You have to repave the parking lot at the end of the winter. There's a lot to it, and everybody's operating expenses will be slightly different because the more you can do yourself personally, then the lower the cost will be. And the lower the expenses, the more the profit. So as I said, income and expense, and you net them from each other. So you remove operating expenses from your effective gross income, and that gets you to the net operating income. Now, this is the most important value in commercial real estate because this is the primary value we use to derive the price. Now, in order to derive the price, it's very simple. You divide the net operating income by the cap rate. And the higher the cap rate, the lower the price. The lower the cap rate, the higher the price. It's a direct relationship between NOI and cap rate. Now, one point that I will make is that the NOI you calculate will be different from the NOI that the seller calculates. But it's very highly likely that the price is not going to change much. But if you believe that you can earn a higher NOI than the seller believes you can earn, well, then you're going to get a great deal. But if the seller thinks you can have a higher NOI than you think you can reasonably earn, then you're going to get less of a good deal. Now, I also want to point out in cap rates are usually quoted in a range. When you're looking for cap rates for a specific property type, a specific property size in a specific market, it'll be a bit of a range. The seller wants to sell the property at the lowest end of that range, and you would like to buy it at the highest end of that range or even higher if you could, because that means the price will be lower. So, as I said, it's a direct relationship between NOI, cap rate, and price, and calculating each one of those variables to get to NOI is ultimately going to be what drives the value of the property. Now, that is going to be the same for every type of property. So just be aware that this general process works in all commercial real estate. So the next thing we have to do is we have to figure out how to derive each one of these variables. So that's what we're going to do in the next section, which we call key metrics. And we're going to dig into each variable one at a time. So we'll see you there.